Okay, so tonight we're going to go over just a review from principles. We're going to look at some of the terms and a lot of the just the basic concepts so that it can refresh what you learned from the principles class. We will have some of this cross over into the managerial class. So I want to make sure that you have a basic understanding of what you learned in that class. So hopefully it hasn't been too long since you had principles and you remember some of that. So it should just be a refresher. We're not going to get too complicated. We're just going to go over some of the basic things. So I posted on Moodle. Let's see, let's share this screen. Sharing my screen now. So I posted on Moodle. Which screen do y'all see? Do you see the Zoom screen?
Yeah.
Okay, because I didn't see it usually highlights it, but I don't see that on here, so it's a little bit strange. Also, I'm going to go ahead and open the chat. See where that goes. All right. So if you see something pop up at the chat, let me know, because you can ask questions as we're going. It can be interactive. You don't have to just listen to me talk the whole time. So on Moodle, I put the chapter 1, 2, and 3 notes from that principles class. That way you had something to read over and get some information. The questions that are on Connect, you should be able to find most of the answers in this information. So, okay, so we're going to look at chapter 1 just real quick, just a couple of things. We're not going to go through a lot of the terms, but I want to make sure you remember the equation. So we have the accounting equation. It's highlighted here on the top of the page. It says assets plus liabilities equal, assets equal liabilities plus owner's equity. Sorry, guys. It's been a long day. I want you to remember that formula because you'll have to do a couple of basic calculations on the test. And so basically, you know, if you have assets and liabilities, you can figure out what owner's equity number is. And, you know, if you have liabilities and owner's equity, you should be able to add them together and tell me what the asset number is. So just real simple. So make sure you know your formula and know how to do that calculation. There's some examples here if you need, you know, a refresher on that. We're not going to go over that stuff. The financial statements. So if you remember in the class, you have a lot of data coming into the organization, and you have to know how to put that information into an accounting software. In class, you learn how to enter that information by hand through journals and try to see how everything is going into what we have now as the accounting software. And once we have all of that data in from all of the sources that come in through the business, at the end of the month or end of a quarter, you have something that you can generate, which is called financial statements. So if you remember the financial statements, we had several different financial statements. We have an income statement. That income statement is what it says, it's income. We're looking at all of our income, our revenue at the top of the statement, and then we'll have all of our expenses that are deducted from that income to come up with a net income. And so I want you to understand that, because on the test I will ask for net income. So if you have some revenue and you have expenses, you need to know which ones are the revenues to add them together and which ones are your expenses in order to do the calculation. Now, you may have other accounts and amounts that are given to you. You have to be able to identify. I just got a message that I can't hear you. Can y'all hear me okay?
I can.
Okay, so anybody else can hear me?
Yeah, I can hear you.
Yep.
Yeah, I can hear you as well.
I can
Okay.
hear you.
Brittany, can you hear me now? Okay, I'm not sure. Let me just put a little message in. So I'm going to want you to be able to identify what accounts are sales, what accounts are expenses, and know which ones to pull from in order to do the calculation. So we're going to go over the different type of accounts tonight, but I just wanted to refresh that financial statements, there's different ones. There's an income statement that said income and expense, statement of retained earnings. So that accumulates what you're making like through the year. And it puts it into a retained earning account. So that way, over time, all of the income or losses is kind of collected into that retained earnings account. Those are cleared out. If you remember from that class, all of the income and expense at the end of your period, which is usually a year, all of those get wiped out and they go to a closing account of like they're called temporary accounts because they get closed out at the year end. And you start over fresh for that new period. So that way, when you're looking at it, you're like, okay, this is my income for this current period that I'm in. But the retained earnings, that account will continually every year grab like whatever's left over. If it was an income or if it was a loss, it'll get generated into that retained earnings account and just accumulate over time. So the statement of retained earnings goes through that, and you learned about stocks and all that stuff. And so you'll have all of that comes into play on these statements. We won't get into any of that in this class. You also have a balance sheet. The balance sheet looks like that equation. It's the assets, the liabilities, and the owner's equity. So I want you to be able to be familiar with those types of accounts and identify them. And we'll go over them in just a minute. And then the statement of cash flows. So the statement of cash flows is exactly what it says. It's how did you spend the cash? What money came in, what money went out. And it shows where you had three categories. It shows if it was from operating, was it from finance, was it from, I'll move my camera. Was it from the investments? And so the statement of cash flow is going to give you all of that information. So this is a little example of an income statement. We just have some revenue, expenses, and the net income. So on the test, you'll have to be able to identify out of several accounts which ones are which. Okay, and these are just examples of what those statements, the other statements look like. All right, so that was the notes for chapter 1. And let's look at chapter 2. Okay, so in chapter 2, we talk about using financial statements. So in this class, managerial accounting is primarily going to focus on what's happening in a manufacturing company, but you're going to have the same thing happening, you know, throughout the semester where we're talking about these financial statements and there's users of these financial statements. And so when you are putting together information that comes out of accounting that's going to these other departments, those managers are going to be relying upon that information. So you're going to have internal users, which are whoever is in the organization with you. It could be management, it could be coworkers. There's going to be reports that you're probably going to have and that come through the accounting department into those other departments. So with y'all not having an accounting major, you may not be in the accounting department. Maybe you're going to be in marketing or finance. Potentially you'll be in management. And so you will be using the reports that are coming out of accounting, and you may have a piece of the financial statement. Sometimes you might be in a role that you see in the whole financial statement. So you're an internal user of the information that's being put out from the accounting department. But we also have those external users. The external users, you know, could be somebody looking to invest in the organization. Could be a banking or a financial institution that's looking to lend you money or finance something for you. So those are the external users. So within the organization, you're going to have all of these reports. So depending on where you are, you need to be familiar with what reports could potentially be coming out of accounting, depending on what your role is in the organization. And so you'll be looking at that and you want your information to be useful. Well, how is it useful? We've got to make sure that that information is reliable, that's going into those financial statements or those reports with a piece that you're looking at. You want to be accurate so you can make good decisions. So we'll talk about some of that during the semester too. All right, so on the chapter 2 notes, it refreshes your memory of what these accounts are. So we have assets. So remember that is part of our formula. So our assets are the resources that are owned or controlled by a company that have future economic benefit. So for example, cash. If we have cash on hand, we can use that for our benefit later. If we have accounts receivable, again, that's money we're going to be collecting in the future. And so we will be able to use that. It's going to benefit, our organization because we have that cash coming in. So if you want to remember what accounts receivable is, remember that you have people sometimes that buy on credit. They will buy something from you. You won't pay. You won't get the money right up front because they won't pay right away. You'll have something called an accounts receivable. You're going to receive the money in the future. So that's how you can remember what accounts receivable is, that it's an asset because you're going to receive money in the future. We have notes receivable, same thing. Maybe I have someone that has a big purchase and I've decided that I'm going to do a note. It's not something that's going to be due in 30 days or 40 days that a normal accounts receivable would have. It's something that I'm going to finance for them over the course of 2 years. So the notes receivable, same thing. I'm going to be receiving money over the course of those 2 years. But the difference is I've set it up in advance and I have that monthly payment that's going to come in every month in order to pay off that note receivable. And a lot of times I get interest with that. Prepaid expenses, that's also something that's going to benefit me in the future. So maybe I had to buy an insurance policy. And the insurance policy is good for 2 years. So I have to pay the whole policy up front. So I'm going to give them, let's say it's, $20,000, it's $10,000 a year. I'm paying the whole 20 up front. Well, that's going to benefit me for the next 2 years. So when we do accounting, that's, if you remember, there's something called accrual accounting versus cash accounting. That means that I'm not going to expense all of that up front. Just because I paid for it doesn't mean that it has to hit my income statement as an expense. It's going to sit in a prepaid expense, which is an asset. And then over time, each month, I'm going to take away from that balance as we go. I'll just divide it by 24 months evenly, and then that's how I'll expense it through the period. And we'll go into some examples because I want you to know how to do that for the test. So prepaid expenses are just like the prepaid insurance that I just explained, but it's not insurance. Maybe it's something else. There could be something else that I needed to pay for in advance and it's going to benefit me in the future. I have supplies. We buy supplies for our organization, things that we're going to be using. We'll pull from those and I'll expense them over time. As I use them, I'll expense them. Equipment, building, land. So sometimes we buy land, sometimes we buy building. In those are our assets and they get set up as a long-term asset on our balance sheet. Then we have liabilities. So if you want to remember liabilities as I'm liable to pay something in the future, I'm liable to, I owe them a service. I have to do something. I have to pay or have to provide a service. That's a liability. I'm liable to pay out in the future. That should help you remember what the liability is. So normally when people sell us products, let's say I have an organization that I'm selling AV equipment and I need to get some projectors and screens. Well, I can purchase them and, from them on an account, which is basically I'm getting a credit And I'm saying, okay, I'm going to buy these from you. I get the product today, but I don't have to pay until 30 days. So that's an accounts payable. I'm going to be paying something in the future. So I'm liable to pay in the future. So accounts payable is a liability. Now, sometimes those accounts will be 30 days. Sometimes you get discounts if you pay early. So depending on how your cash flow is, you may pay some things early and get discounts. But that's what the accounts payable is. That means that I have something that I purchased and it's usually going to be due and within 30 to 45 days, possibly have a discount on it. Notes payable is very similar to an a notes receivable, where it's going to be something that maybe I bought a big product and I've set up a note because this particular projector maybe was $100,000 and it's, you know, for a big theater and it's going to cost a lot of money and I don't have $100,000 to pay up front. So maybe I set up a notes payable. So every month I'm going to pay a monthly fee plus interest. And I'm just going to have that repetitive every month that I have to pay out. But again, payable, I have to pay in the future. So unearned revenue is a little tricky. A lot of people get confused with that. It's something that I owe, but not in money. I'm not going to be paying out something because I'm not paying out. Somebody has paid me to do something. So I have money that I've collected, but I haven't provided that service yet. So maybe somebody comes and says, hey, I want you to come in and give me some consulting on my accounting department. And it's going to take, you know, 2 months to finalize the whole project. Well, they may pay me up front for the whole 2 months. And let's say it's June, I got the money, but I'm not doing the job until October. So I've collected money, but I haven't provided a service. So I'm holding on to somebody's money that I need to provide something in the future. So I have to set that up as a liability. So people that are reading those financial statements, they understand that I am liable to provide something. If I don't provide that service, I have to pay that money back. That's what an unearned revenue is. So it's basically sitting as a liability on that balance sheet, showing someone that I have this allotted money that I haven't provided, you know, any service for yet. A lot of times we have footnotes that go with financial statements and they let the user know what some of those things are for. And you can, you know, you can list out what that is in those notes. So once I complete the job, then it's no longer unearned because I've earned it. So maybe that first month, if I got paid, you know, $10,000, it's $5,000 a month. Well, that first month I'll recognize $5,000 as revenue and I'll put it on my income statement and I'll remove part of it off of my unearned revenue because now I've earned it. And then the second month I'll do the same thing. I'll do an adjusting entry to recognize the income for that. Okay, so this, you know, is just a little quick recap for you to be able to look at, to know, and kind of explain what some of those accounts are, because I want you to know what those are for the test. And okay, then we have equity. So that's the owner's claim on a company's assets. That's called stockholders' equity or shareholders' equity. So that can include common stock, dividends, revenues, goods, services, sales. So whenever our sales and expenses go in, that's always part of our equity. Remember that that retained earnings goes in, all of that goes into our retained earnings, and that's all of our equity. Okay, so then we have a chart of accounts. And what that is, we have a ledger and we have a listing of account numbers. Usually there's account numbers and descriptions. And so literally all that is saying, okay, here's a list of account numbers with names of the, you know, the account, like maybe it's cash, maybe it's accounts receivable, it's accounts payable, sales. So we're going to be using those to provide a posting area for our transactions that we have from the sources that come into the organization. So all it is a listing. So a chart of accounts is literally just a chart that gives us the list of names and numbers probably. So usually you have both. Sometimes you'll have smaller companies that maybe don't use the numbers, but most of the time when you work for larger organizations, they'll have account numbers that go along with the descriptions. So we have our general ledger. So the general ledger is just that listing, and that's what we use when we're coding things. So maybe in receivables, we're coding to a 1,200 account, and payables, we're coding to 2,000 accounts. And a lot of times it's categorized that way. You have ones or assets that are like cash or something that can be, it's got a quick liquidity. And then you have twos that are liabilities, fours or sales. So they'll group them. And a lot of times it's very similar from one organization to another. Okay, and then we have that double entry accounting. So I know that you probably remember whenever we have something that happens, there's always two sides. Remember the debits and the credits. So we have a journal entry that we'll enter, and we put this on the paper and we post it in. Now, what actually happens in practice when you have a computer system is a little different. You don't actually see that unless you're doing a journal entry. But through all these transactions in class, we had to do a journal entry in order to record into those accounts, and there's always two, and they always have to balance. So I could have more if maybe if I have let's say I have somebody that decided they wanted to buy something from me and I'm selling them a product. Well, maybe they paid me part cash and they're going to pay the rest on account. Well, in that case, I have two different assets. I have the cash that's come in. Maybe they paid me 500, so I have that cash, and then the other 500 is going to be on accounts receivable. And then I have, you know, the sale of the product, and that's just $1,000. So I'll have three accounts in that case. I have two debits and I have one credit, but in the end, they reconcile, they balance. I have 500 plus 500, which is 1,000, and then I also have 1,000. So hopefully that makes sense, and you remember that from the first class. If you always have two accounts, and we have T accounts, we will do some journal entries. I try to make sure that we're not just looking at how we calculating different ways. Like you'll see what I'm saying when we start going through the class, where we'll do different calculations that are just number calculations. But I also want you to see what's happening through the financial system and what's happening on the journal entry side. So some of the homework, you'll have journal entries that you'll have to do, and you have to remember there's two sides to that, and they have to balance. There's also those T accounts. Hopefully you know how to do T accounts. Those are when we set up the little, let me open up, I'll show you what it looks like real quick. Let's see where my screen opened. It opened on the wrong screen, so hang on one second. It's thinking. Okay, so when we have a T account, it looks something like this. And maybe this is for accounts receivable. And I sold something to Mary Jo, and it was $1,200. So I have a debit. So this side is always going to be our debit side, that left side. And this side over here, the left, is always going to be the credit side. So when I had the sale, I have a debit to $1,200 because I'm going to get that later. I'm not getting that money now. So it sits as an asset. Assets carry a normal debit balance. When she pays it, then I'm going to clear that receivable off. It's going to be a credit. So we can look at different transactions and put them in on a T account that looks something like this to help us see what is the account balance at the end. So the T is set up for one account. So your transactions that are going in there, your numbers on either side, are always for that same account. So if I was looking at a transaction and it's got two sides, I'm only looking at it from one side when I'm doing a T account. I would have to set up a separate T account. Maybe it's cash. So in this transaction here, I'm getting money in, so I'm debiting my $1,200 and I'm crediting my accounts receivable. So now I have two different T accounts. And I found this to be very useful when I was in school and learning how to figure out what was happening in my account. Just remember that when you set this up, it's only for one account that you're following. You're just looking to see what's happening in that one account. So even though there's two sides to it, you only want to follow what's happening in this one account, and you put your numbers in there, and then you can calculate it at the end. Okay. Do you have any questions so far? Okay. So we're going to look at trial balance. What happens is when you start putting information into a ledger or to an accounting software, you're going to have a lot of different transactions. So you'll have multiple asset accounts, multiple liability accounts. You'll have equity accounts. You'll see all those expenses and revenue accounts listed on there. What happens is maybe I want to see what the balance is in all of those accounts. So I can usually run a report from the system, and it's called a trial balance. And when I print that out, all it's going to give me is a listing of all those accounts that I have with the description. So it might have the account number, the description of the account, and then it's going to give me a number. And it's either going to be in the debit column or the credit column. In the end, at the bottom, when they total up the debits and total up the credits, they will match. If they don't match, then your trial balance is out of balance, and you got to figure out why. So that's what a trial balance is. All it is that listing with the totals that are in that account. So maybe I had 10 different sales and a collected cash for every one of them. So what'll happen is on the trial balance, it's not going to show me all 5 transactions. Let's say the total cash that I collected was 20,000 out of all 5 transactions. When I run the trial balance, it's just giving me that ending number. So maybe I didn't spend anything. I just had some sales. And so it was 20,000, and that's what my ending balance is, 20,000. Maybe I decided to buy some things with that money, and I spent 5,000 of it. So then instead of showing me the 20,000, it's going to show me 15,000. So it's literally just the number with an amount, and it lists them all on there so you can see everything at once. So a lot of times this is run, it's looked at, it's reconciled to make sure everything balances. And then we do something called adjusting entries, and we rerun it, and we call that an adjusted trial balance because we made adjusting entries. And we're going to go through some of the adjusting entries when we look at the chapter 3 notes. Let me see if there was anything else in here. So here's your example of a T account. Your left side's a debit, your right side's a credit. That can be useful. Could be useful during the semester too. Okay, this is explaining the real accounts. So things that we talked a little bit earlier about those income and expenses. And that each year we want to know how much we're making. How much are we making? And as far as like what we're bringing in as revenue, how much are we spending? And every period, remember I said those were temporary accounts because every period we want to start over and look at the new period. We don't want to have it all jumbled together. So those are temporary accounts. The real accounts are those assets, liabilities, and equity. So if I have an asset, let's say I have a bunch of accounts receivable and it totals 100,000. At the year end, I can run a report and it shows me, here's all the names of my customers, clients, tenants, whoever they are. It'll give me a list and it'll show me how much they owe me. Well, at the year end, I don't want that to go away, right? I'm still owed that 100,000. So I'm not going to close those accounts. I'm not going to do anything. It's just giving me a listing of where am I at 12/31. Let's say it's my year end. It's going to give me a snapshot and say, okay, here it is. It's 100,000 and this is where it's coming from. You know, you have 20 customers and these are the amounts that they owe. And so you don't want those to go away. Those are called real accounts. Those will stay. Your cash, you don't want your cash to disappear, right? It's going to be in the bank when you have a bank statement from one year to the next year, your cash doesn't change. That ending balance is your beginning balance when you go forward. It doesn't go away. So that's what an asset is, and the liability works the same way. If you owe something, you don't get to wipe it out. I wish that was the case, but we don't get to wipe it out at the year end and then start over fresh. We keep that liability that we owe moving forward. So when you have a car that you purchase and you buy that, let's say from Toyota, and you have 20,000, well, during the year, you're going to pay on that. When you roll into the next year, If you didn't pay it all, it's not going away. It's still going to have a balance. It's not as much as it was in the beginning of the year, but you're still going to owe the rest of the 4 years. So that's a liability. It's going to stay on that balance sheet saying, okay, I still owe this. And so I'm going to have to keep that. It's a real account. And the same thing with your equity. Okay, there's your temporary accounts that you close out. We're going to just mainly be focusing on revenue and expenses. We're not going to get into dividends in this course. Okay, so let's look at chapter 3. So chapter 3. Okay, so we talked a little bit about accounting period. I've mentioned that a period is usually a calendar year or 12 months. Sometimes it could be longer, sometimes it can be shorter, depending on what type of organization it is, but it's just it's a period of time that your activities are in. And like I said, normally it's 12 months. So if we have a 12-month period, we can break that down. Maybe we have a mortgage on a building and we rent the space out to a bunch of different tenants. And that mortgage company wants me to provide them with a quarterly financial statement. Well, I can break it out into the quarter, which is 3 months. So we have 4 quarters through the year. And I'm going to send them first quarter, January, February, March. So I can run a report that gives me all of my income and expenses for that first quarter or that second quarter. So they can look to see what's happening. And so you can have different intervals that you can run reports. Some people prepare them monthly. So it just depends on the organization that you work for. We have a 1-year period known as the annual financial statement. So that's the whole 12 months. We have something called accrual and cash basis, which I mentioned just a little bit ago. The accrual basis means that we're going to recognize the revenue when we provide that revenue. So remember I said sometimes we might get paid, but we haven't done the service yet. Well, we can't recognize it as revenue because we haven't earned it yet. It's unearned. And so we put it into a liability, and then we recognize it when we actually provide the service. So we have revenues being recognized when they're performed. And then we also have the expenses recognized when we have the expense incur. Remember, we talked about that prepaid insurance. Well, I paid a bunch of money up front, and I'm going to take it and divide it by 12. And little by little, I'm going to put on my books that expense. So that's what I'm talking about when you recognize the expense when it happens. So we're not taking that whole $20,000 that we paid for insurance and expensing it when we paid it. We're going to just divide that by 24 months, and then we'll break it down each time, each month, each quarter. We'll show that amount that we posted for that. So we're matching them. We're matching when we're providing the service and when we're actually benefiting from that expense. We're going to match those together. Now, cash basis is different. Cash basis, if you're small, you're just maybe you decide you want to do a landscaping business, and you go out, you get some clients, and you're cutting grass. Well, some of those customers might pay you that same day. Some people might pay you monthly. Some people might pay you every other week. It depends on the terms that you set up with your customers that you gather as you go. Well, if you're just yourself and you have this little business, you may only put in when you get paid as your income. So that whenever you collect the cash, that's considered a revenue. Whenever you make an expense, so you went out and you bought gas during the year, well, everything that you spent on gas becomes your expense. So it's not like, oh, I'm going to go ahead and buy some fuel in advance, and I'm going to put that as a prepaid expense, and then I'm going to expense it as I go. That would be accrual. This is strictly going by cash. Did I receive cash? If I did, it's income. Did I pay out cash? I did. So now it's expense. So if I paid for insurance and it's for 2 years, that policy, well, I'm going to expense the whole thing because the cash went out. So I don't split it up and divide it up amongst those months. I just go ahead and recognize it as an expense. That's the difference between the two. So I want you to know that because that'll probably show up on the test. So cash basis and accrual basis. Just remember, cash is whatever happens with cash. If I spent it, it's an expense. If I collected it, it's a revenue. If I'm collecting it later next year, don't include it. So they might have a question that will throw something like that in, that you're going to collect it over here and you got this. Right now you collected this, but you're going to be paying this out later. Make sure you pay attention to the wording because you only want what actually happened with cash. All right, so we talked about adjustments earlier. We said that we had a trial balance and then we would have to make adjustments sometimes. Well, those adjustments are something similar to like prepaid expense. So we are going to do an entry called an adjusting entry, and we're going to record an expense. Or I provided that service, I provided that, whatever service it was that I agreed to, and I got some money for, I'm going to go ahead and recognize that as revenue when it actually happens. So no cash is being transferred in either one of those transactions. So think about your adjustments usually are not going to have any cash involved. Adjustments are strictly making adjustments. Maybe you had an error and you needed to make an adjustment. Maybe you have recognized revenue because you provided a service, or you now are going to incur an expense. Maybe you bought some equipment and you have depreciation that you have to recognize over a period of time. So think about an adjustment as being something that is not involving cash. So a lot of times in principles class, people get confused and they want to throw cash in there, but you're not actually paying for anything at that time, or you're not actually receiving any money at that time. You're just doing an adjustment to the books and recognizing revenue, or you're recognizing an expense. So that's what an adjustment is. Okay, so this kind of breaks down some of those adjustments. We're going to talk a little bit about some of them. So the prepaid expense, we talked about that with the prepaid insurance. So here's an example. So we have that summer fund paid $2,400 January 1 for 12 months of benefits that began January 1, and the current balance is $2,400. So I'm just saying, we spent in $2,400, we paid it, we put it into an accounts payable account, and the offsetting account to that was prepaid expense. Because remember, we have two sides. So we had debit to prepaid expense, credit to a liability. And so now I have this balance in prepaid for $2,400. So it says a portion of the insurance will expire and the asset becomes an expense. Insurance expense will be $200 each month. So we take it and we divide it by 12, and then we get the $200. So a total expense for the first quarter, so remember the quarter is 3 months, so we just take the 200 times 3, we get $600. The balance should equal $1,800. So after I make my adjustment, I need to reduce that $2,400. Well, if you know that an asset account normally carries a debit balance, well, then you know you have to do a credit to reduce it, because it's sitting at $2,400 and I want to reduce it, so I have to do a credit. So here's my entry. So I have insurance expense. Whenever you record an expense, the only time you ever really going to do a credit to an expense is if you're getting something, you've gotten a credit back for something you've returned or something like that, or you've gotten a credit for something maybe that you overpaid and you got a credit. So you had an adjustment that you had to do, so you have to credit expense. But anytime you have an expense, that's a debit. So we have an insurance expense for $600, and then we reduce in that asset, prepaid insurance. We're going to do a credit for $600. So this is just to record our expense for the first quarter. So each time the quarter ends, if I do it quarterly, this is the entry I'm going to do, and I'm going to do it 4 times for that year. So that's what an adjustment is. So I'm basically adjusting my expense there, right? And I'm reducing an asset, which is my prepaid. Here's a T account, if this helps you understand what's happening. The T accounts can be helpful. All right, so here's another example with supplies. So same thing, we are purchasing supplies, $10,000. That's an asset. We're bringing something in that we're going to use later in the future. I'm going to use those supplies later. So that's an asset, which is a debit balance. So I have supplies expense debit $1,200. And then I've used some of my supplies and I have to credit that off. So if I have an asset of supplies, how do I reduce it? I'm going to do a credit. Again, expense, debit. Revenues are credits, expenses are debits. That's the norm. Here's the T account. So, and there's a little explanation there. Okay, so let's look at depreciation because I'll have probably a question on this. So we're not going to, there was different methods that you learned in principles. We talked about different depreciation methods. So we're only going to talk about straight line in this class, which just basically means that I'm going to look at equipment. Let's say I bought equipment. I'm going to look at it and say, how long is this good for? It's good for 5 years. Well, I'm going to divide it by 5 years, expense it evenly over time. That's what I mean by straight line. I'm not doing anything fancy. Like I'm going to, you know, depreciate more up front. I'm going to go ahead and do it evenly over time. So that's how I want you to know how to do depreciation for this test. And then for when we get into it in the managerial stuff. So we have a special category for those prepaid expenses. We call them plant assets. They are long-term assets. Those are things that we're going to have for a long period of time. So they show up in the long-term section of the balance sheet up under the asset section. And we're going to use those to help us produce and sell a product. Or we're going to have that in order to bring in revenue. So if we bought a building and we have tenants, we're going to bring in revenue through those tenants. So that's going to be something that's going to provide, you know, a service that's provided year over year and it's bringing in revenue. So we have plant assets that are expected to provide benefits for more than one period. So normally when we buy these, they're going to last a long period of time. Most of what we're going to be talking about in our class are things that happen in a plant. And we'll talk about some equipment that could potentially be in those, in the examples that we look at, that can potentially be part of the plant that produce products in order to bring in revenue for the plant. Okay. So we're going to record a little bit as we go. So this is the formula. We have the depreciation as a process of allocating the cost of the plant assets over the expected useful life. So we have straight line, which equals, we're going to take the asset cost minus the salvage value, which will be given to you, and divide it by that useful life. Again, it's going to be given to you. So that is straight line. So we're just looking at the total amount, take out that what we expect it to be worth of the salvage value, and then divide it over the useful life. And that's how I'm going to expense it throughout the life of the asset. That's the straight line, which allocates that equal amount during the year. Okay, so I don't know if you remember this term. Some people remember it, some don't. A contra asset account. Basically, that means that when I put, let's say I bought some equipment, it's going to go on the books. I bought the equipment, let's say for $100,000. The equipment goes on as a long-term asset under plan assets, equipment, $100,000. Well, when I depreciate it, it's not going to go in directly into that equipment account. When we talked about prepaid, I talked about doing a credit right into the prepaid account to reduce it. We don't do that with plant assets. With plant assets, once you put it on there, it stays at that amount. We have something called a contra asset account, which is accumulated depreciation. That's the name of it. And instead of sitting as a debit, it sits as a credit. So it's an asset account that sits as a credit, as a normal balance, which is called a contra asset account. So it doesn't work exactly like the asset accounts do. It's a little bit different because it's offsetting the equipment. So maybe that first year I depreciated $10,000. So the way it's going to look on my statement, I'll have an amount on there for $100,000 under equipment, and then I'll have accumulated depreciation $10,000, and then it'll give you the balance of $90,000. So that's how it's going to look on the balance sheet. And when you're posting, just remember you have to use accumulated depreciation. Don't go back into the equipment account. A lot of times you'll have multiple assets for an organization. So a lot of times you'll have multiple accumulated depreciation. You won't have one. So if I have equipment, it'll say accumulated depreciation for equipment, accumulated depreciation for auto or vehicles, accumulated depreciation for building. So I'll have several different ones for each plan asset that I have. Okay, so here's an example. So I purchased some equipment for $15,000 in January. The equipment is expected to have a useful life for 4 years. It's worth $3,000 at the end of the 4 years. So I'm going to do my calculation. I'm going to do the 12,000. I mean, the useful life is 12,000, which is that 15,000 that I paid minus the 3,000. So I get 12,000, and then I'm going to divide it by 4 because I had 4 years. So that gives me a yearly number. If you want to figure it out by month, depending on how they're asking you the question, you know that 4 years has 48 months. So I'm dividing it by 48 months, and I come up with $250. So if I'm entering it monthly, I do $250. If I ask for yearly, you would just divide it by 4, give me the yearly number. So it's important when you're looking at adjusting entries to make sure you look to see what they're asking for. Are they asking for a quarter, which is 3 months? Are they asking for 12 months? Or are they asking you for a monthly number? So you know how to do the calculation. So it's simple. You just got to remember which one, know which one it is so you can get the right number. Okay, here's the journal entry for depreciation. So I have depreciation expense, $250. That's my debit. And then remember that contra asset account that I said was accumulated depreciation? There it is. So we're going to credit $250. So it's in balance, credits and debits equal, and I've reduced my equipment. So now when it sits on the balance sheet, it'll have a balance of $15,000 for the asset, the equipment, and then underneath it, it'll have accumulated depreciation $250. So it'll just reduce it. And there's the T account. All right, let's look at an example for unearned revenue. We talked about this. This is where I got paid. And then I have to recognize the revenue when I actually provide the service. So we have Summer Fund received $3,000 cash from a customer on January 15th, covering February and March rental services. So the entry to record. Now, at this point, when I collect the money, I didn't provide the service yet, right? We're in January, and it says it's covering February and March. So do I have a revenue yet? I don't. So I'm going to go ahead and put my cash in. That's my asset debit, $3,000, and my credit is unearned revenue. Have not earned it yet. So it's $3,000. What type of account is unearned revenue? It's a liability. Make sure you remember that. It's a liability. Anytime you owe, there's a liability. It's normally a credit balance. All right. So now let's look at the next part of this. So it says at the end of February, Summer Fund earned $1,500 of rental service. The revenue recognition principle implies that $1,500 of unearned must be reported as revenue for February. So now I've provided the service. I don't want it sitting there saying, okay, I still owe $3,000 to somebody. If I don't owe them that service, that equals that amount, right? I want to reduce it. So how do I reduce it? Well, remember, it's sitting as a credit. So if I want to reduce it, now I'm doing a debit. So just because you're reducing an account doesn't mean that you're always doing a credit. Sometimes you're doing a debit and you're reducing an account. So don't let that confuse you if a question comes up like that, because I do like to ask that sometimes. If you have an entry, is it always a debit or is it always a credit in order to reduce something? So be careful of the wording, because sometimes in order to reduce an account, you're not doing a credit, you're doing a debit. So here we go. February 28th, unearned revenue, $1,500. So now what happens to my balance? It's no longer $3,000, it's $1,500. And I'm going to recognize my revenue. Rental service revenue, a credit of $1,500. Remember, those revenue accounts are usually always credits unless you're giving somebody a credit. Here's what it looks like on the T account. So that's an adjusting entry. Again, no cash was involved in this second part. That's the adjusting entry. When we receive the cash, this is the initial entry that will happen from that transaction. So we receive the cash and we put that in the system. So now when I do my adjusting entry, there's no cash involved. So that's why there's no cash in that entry. Okay, accrued expenses. What that means is I don't have a bill yet, but I know that I've already been provided the service and I need to put it on my books because I want to recognize it as an expense. So one that we do a lot of that with is like, let's say utilities. So maybe the bill came in and it's good through June 15th and I pay that bill. Well, what happens from the 16th to the 30th? I'm not going to get billed until July. Well, if I'm doing accrual basis accounting, sometimes like I work for a company that owns a lot of real estate. We have large buildings. So some of our electric bills are huge. And so we want to recognize that 15 days that was in June that we didn't get billed for yet. So we'll estimate, okay, this is what it's been over maybe 3 months, and we'll divide it up and figure out what it is for 15 days. And we'll record that as an expense. That's called an accrued expense. I know that I've incurred it. We've been provided the electricity for the building, so I just haven't gotten the bill yet. So it's an expense that we put in, and it's called accrued expense because we haven't gotten the bill yet. It's just accrued expense. Okay, then sometimes that happens with salaries. When you get paid, it's every 2 weeks. Sometimes it crosses over from month to month. So maybe I worked 1 week at the end of the month and 1 week at the beginning of the month. And I know I get paid, let's say it was January and February. I'm getting paid in February, but some of that expense needs to go in January because that last week that I worked is part of January. So the company will do an adjusting entry in order to record the salary expense for that period of time. So that's an accrued expense. I didn't pay it out yet, but I know it's coming. If you have interest, a lot of times that's the same thing. We don't pay the interest until the next month, and I had interest that I incurred for this month, or maybe it's a note that's not due yet. I'm not going to pay it until 3 months. I have to recognize that interest, you know, when I had the expense. So I'll do an entry for that. So here's an example with the salaries. So we have an employee that earns $80 per day, $400 per week, Monday through Friday. The employee is paid every 2 weeks on Friday. On December 12th and December 26th, there are 3 working days after the payroll ended on December 26th. That employee has earned 3 days salary by the end of December, but they won't get paid until January. So 3 days worked, which is $240 a day. You know, you gotta do, I mean, $80 times 3 is the $240 for those 3 days. You need to accrue that in December. So we'll do an adjusting entry at the year end to recognize that expense. So in December, we have salaries expense debit, $240. And then we have salaries payable, $240 as a credit. So remember that I am liable to pay my employees later. So that's a payable, and it's a liability because I'm liable to pay it. And that has a normal credit balance. Okay, so now you can see what's happening in the salaries expense, just kind of giving you a breakdown of what happened. So in December, on the 12th and the 26th, we have $400 that went in. And then on the 31st, we have 3 days. That's $240. So it shows you what your total expense was for that month. And then at the year end, I have that $240 payable. So now when we look at it, when we actually pay it in January, what happens? Well, in January, I don't want to recognize 3 days expense in January that actually happened in December. So remember that payable. Well, the payable account is still sitting open because that's a real account that came forward. What happened to that expense? It's temporary, it's gone, right? It's with December, it's in that last period that happened in that year. So now when I'm in January, I don't need to expense those 3 days because I have the payable already set up for it. So now I'm just going to expense the difference. So I need to clear my payable. If it's sitting as a credit, I got to do the opposite. So I'm debiting salaries payable $240. And then I need to expense the rest. So the difference is $560. So here's my cash, $800 that I'm paying out. So we paid 2 weeks. And we had that 3 days accrued in December. So we're going to clear the payable, and then the expense doesn't hit January.
So interest, let me see. I don't remember if we had a calculation for interest. Let me see before we go into going over that. Nope, we don't have to do that one. So we have accrued revenue. So this is a revenue that's earned in a period that are unrecorded and not yet received in cash. So we have a technician or a company only bills when the job is done. So maybe we can't bill the client the job until it's completed. And maybe it takes us 2 different months in order to complete the job. On my books, I know that a portion of it is in the first month and a portion of it's going to be in the second month because I've done some of the work and I can't bill them yet. So I haven't gotten paid. I haven't done a receivable for it. So I might do a journal entry and record it as an adjusting entry, recognize the portion that was done in the first month as revenue, and I would just set it up as a receivable. So I wouldn't actually maybe send that to the client or the customer, but I have to put it on my books. And so so maybe it's just going into an other receivable account until I can bill the whole thing at the end, and I can clear it out of that other receivable and set the whole receivable up under the tenant's account or the client's account, and then bill them when it's done in full. So sometimes that happens. All right, so recorded, okay, account accrued services revenue. So we're going to have recorded when the entry of the adjusting entry at the end of the accounting period. So Summerfront has agreed to provide rental services to a customer for $2,700 from January 12th to February 10th. So it's 30 days. The customer will pay for the rental service on February 10th at the end. So at January 31, I have 20 days of rental service that's been provided, and these services have not been billed or recorded. So since it hasn't been billed through the system, I need to do an adjusting entry. So we've earned $1,800. So we have 27 times 20 days over 30 days in order for me to figure out how much it is. So I have 1,800. The revenue recognition principle implies that 1,800 must be reported in January on that income statement. So we want the balance sheet to show that the customer owes us $1,800 as well, because they are going to owe that. So we're going to do the adjusting entry. So like I said, we can use the accounts receivable or we can use a different receivable. It depends on how the organization is structured, on how they do the entry. So for here, we're going to do a debit to accounts receivable for $1,800, credit the revenue for $1,800. So remember, accounts receivable is an asset. Assets are normal debit balances. Revenue is a normal credit balance. So we're going to have a credit for revenue, and that's to record our 20 days. Okay. So now we're going to receive money because we're finished. So we're going to finish the project, and then we're going to receive the money. Summer Fund will receive the cash for $2,700 on February 10th. That's for the entire contract, right? Because they're paying it in full. An entry will be made to move the accounts receivable. We're going to take the receivable off at this point because they're no longer going to owe it, so we can't have it sitting there. And we're going to recognize the revenue that's for February. So remember, it's not going to be the whole thing. It's going to be the balance of what we had billed the previous month, and then it's just going to be the remaining amount that goes to revenue. Well, cash is an asset account, so it's a debit, and I'm getting the whole amount, so $2,700. I need to remove the accounts receivable because now they don't owe me anything, so I'm taking that off, $1,800. So it's sitting as a debit. In order to clear it, I have to do the opposite, which is credit. And then I have another revenue. Revenues are credits by that difference. So that's what I need to recognize as revenue for February, $900. So my my journal entry is in balance. All right, so this here is just something that's, a little cheat sheet that kind of helps you understand what happens if an adjustment is not made, if you have prepaid expense and you don't do that, something could happen. will have too much of your assets on your balance sheet, so it's overstated. And what happens to expense, because that's normally where it goes. So if you don't do the expense, it can be understated, because there's no expense on there when we should have had one. So this hopefully will help explain that thought process when you're looking at it, if an adjustment's not made, or what happens through the adjustment process. What does the adjustment entry look like? So for a prepaid expense, it's going to be a debit to expense and a credit to an asset. Unearned revenue, what's that entry going to look like? It's a debit to a liability and a credit to a revenue. That's when we are making that adjusting entry. That's what the adjusting entry is going to have. So if I have unearned revenue that now I've provided the service and I didn't remove it through my adjusted entry, what happens? Well, let's say that example that we had, it was I don't remember how much it was, but let's just say it was $2,000. Well, I needed to provide, $2,000 worth of service. In the first month, I did $1,000. If I don't put that on there, what happens to my liabilities? Well, it's overstated. It's saying that I still owe $2,000. I didn't do the entry. But do I still owe $2,000 worth of service? No, I only owe the $1,000. And then what happens to the equity? Well, that's understated because I don't have my revenue on there. So if I don't have my revenue, then it's understated. So hopefully this table kind of walks through the process of what you're doing through those adjusting entries and understanding. You may have one question that you'll have to work through like that and understand if it's overstating or understating if you don't do that adjusting entry. We talked about the trial balance. I said that it's just a list of accounts with the numbers. And remember, the term adjusted trial balance is after you make your adjusting entries. So if you run it before you make those entries, it's called the unadjusted trial balance. Once you make your entries and you run it again, now it's been adjusted, right? Because you made those adjusting entries, so it's called adjusted trial balance. So it should be pretty easy to remember. This is an example of what that looks like. So I have some changes that happen. So right here with accounts receivable, I didn't have a balance before, but then I did an entry, an adjusting entry, and it became 1,800. Well, now here's my adjusted trial balance with that total now being 1,800. So remember, the trial balance is just a list of the accounts. Sometimes the account numbers on there as well. And then it has the amounts that are in the accounts. I'm not going to ask you to do anything like this where you have to make adjustments on the test. We're not going to do that where you have to put it on the trial balance. I think the only thing I had on there was what I had told you about, which was knowing how to come up with net income, looking at some accounts, know what the accounts are. It's not going to be anything too complicated. It's everything of what we talked about here tonight, like knowing what those accounts are, those ones that we went over, so that when you see them, you can say, okay, this is an asset, this is a liability, this is a revenue account, this is an expense account, so that you can pick up on that and do your calculations. If I ask for net income is revenue minus expenses. Let's see if I had any other. We're gonna have a couple of journal entries. They will be multiple choice. So you'll have that to choose from. It'll either be written out in the format of a journal entry like I have on here, right here. They may give you different ones to choose from. You have to say which one's, the right one. And then there's other times that it's just, wording. So it may say debit to this account, credit to this account. It won't be broken out like that, but there'll be multiple choice. Yeah, that's the only one that I have like that. So you won't have to do any kind of trial balance or anything like that. We're not going to go through any closing entries. We're not doing classified. And that's it for that. Okay, so that was it for chapter 3. So like I said, let me bring up the Connect account real quick. Hopefully everybody's been on Connect, they've registered. Maybe you've started the homework. There's 2 chapters that'll be due by Thursday next week. Okay. So you should see those open on the Connect account now. Student view. So it should look like this. You're gonna just bring this down. It'll show you the dates that they're open. And you just click on it and you can go into it to do the homework. So those 2 are due next Thursday, September 1.
Is the test next week also?
No, so if you look at the schedule on Moodle, I have that here. I have a link right here too that I put for the introduction if you didn't get the email with the YouTube channel. I probably won't do that every week. I'm gonna just send the email with the link to YouTube so you can listen to the lecture. But if you look at the schedule here, I did do a revised schedule and got rid of the Mardi Gras holiday because obviously we don't have that. And that just, it wouldn't open. Hang on. I'm not sure why. It's saying it's a protected view. So let me get it from my file. That's the first time it did that to me. Hopefully this is the updated one. Yes, it looks like it. So that last week that y'all had those final exams, you'll be done with this class. You won't have to meet with me. So we're not doing the test until August 29th. So I actually have, let's see, where's my calendar?
That's next week though.
Is
Yeah,
it-
August 9th is like in a few days.
What's today? Today's the 20.
Today is the 20th,
25th.
so that's in 4 days. That'll be like on Monday.
Oh, well, it's not going to be Monday though. It's not going to be Monday. Okay, so I did change it. Okay, so I put the exam first and then we start the managerial. Okay, so yeah, so you have the homeworks that you work through this week. Those will be due by the 1st, which is Thursday next week. The test will also open up on the 1st of next week. So the week starts the 29th. So the actual test date, I'm going to open it on Thursday the 1st, and it'll be open all the way until Saturday the 3rd. So if you can't do it on Thursday or Friday, you have Saturday in order to get the test done. So try to take it early because I think that this is a holiday weekend, right? We have Monday. Yep. So I'll open the test on Thursday. The other option is to do a lecture next week and have the test the next week.
Let's do that.
Y'all want to do that?
Well, for the test, is it gonna be the information that that we're discussing during these lectures that we're having? Well, this
Yeah.
is the first one, or is it gonna be like the information from the test? I mean, that's gonna be like on the homework to help us.
Yeah, it's going to be what I just lectured on in the homework, which should all kind of be the same. So
Okay.
so it's just the information we went over tonight, just the review. But we can swap it out if y'all want to do the test the week of the 5th. That way you're not doing a test on the weekend of a holiday. We can do the test opening up on the 8th instead. And next week we'll just do on Thursday night, we'll do the lecture for the managerial accounting chapter 1.
You said it doesn't close till Sunday night, right?
Saturday, I usually leave it open 3 days. Thursday,
Okay.
Friday, Saturday. That's normally what I do.
Yeah, honestly, I would prefer for it to be the week after the holiday.
Okay. So somebody's saying test before new material. So I'm trying to figure out
Yeah, I agree with having the test before we take on new material.
Me too.
Same.
Okay, so everybody's kind of looking at doing it next week.
Same.
I have more of doing it the way the schedule's set. We have
For
like,
the format of the test, is there going to be like a study guide? I know you said it would be on what you lectured on in the homework, but will we have like a study guide to kind of like, you know, have a basis of what the test might look like?
yep. So, so right here where topic 3 is, I'll go ahead before the weekend and put up a study guide for you. This will just be some notes telling you what to study. It could be example problems. So if you look at, let's see, let me go into the homework. So the questions are going to be pretty similar to the homework as far as the structure goes. See how they're just, you know, true, false, you got some multiple choice in there. The test will be similar to that, same type of format.
Okay, thank you.
Again, I mean, if you know, hopefully you haven't had principals too long off and you remember some of this information. But if you know, just go over some of the things that I focused on, do the homework, and then focus on learning everything that's on the study guide. You should be fine for this test. It's not super hard. I tried not to put anything too tricky on there, so it helps, you know, kind of get you a good going, you know, good start. So okay, so it says, so the test is on September 1st, correct? It is today, right? I don't know why I keep flipping over here. Okay, so yes, it's going to open up on the 1st. Next week. And let's see. Okay, I think that's all of the questions in the chat. It looks like most people are fine leaving it the way it is. So we'll go ahead and leave it the same. Okay, so if you have any questions this week or this weekend, go ahead and email me if it's something that you're having a problem with. I want you to send me a text message and let me know. And
Somebody
then,
just asked on the chat, are we meeting next week or no?
right, no, we don't have to meet on Zoom next week because we're just going to open up the test. And then you just take that when you want. I'm not scheduling lectures on the same week that we're doing a test. So normally in class, I'll go in, we'll do the test, and we'll go home. So I'm going to do that basically the same way. You just get online, take the test, and then we'll meet next week to start the new series. So no Zoom next week. Yep, no meetings on test week. And email me if you have problems. I'm going to go ahead and open up a practice Proctio test just so that you can open it up and just see what it's asking for and make sure your computer is compatible before you open the actual test. If you have any problems with the test where you've lost connection, because that happens sometimes with online classes. Sometimes we have, you know, something that happens, it goes down while you're in the middle of it, or there's a problem. Just try to take screenshots, send me an email, let me know what's going on. If you're trying to take the test, make sure you send me a text message and let me know so that I can try to, if I have to email, connect, or get you a support number in order for us to work through that for you to be able to take the test. So just make sure you text me on those.
Is the test on Moodle or Connect?
Connect. Yeah, so you see how I have the exams category on the, well, you can't, don't have my screen anymore. The way that your screen shows now homeworks under a category, you'll see a category that says exams. And under there, it'll be right there. Yep. So I'll open up the test Proctio by the weekend, and I'll also put the lecture up on YouTube, and I'll also put up the study guide. So somebody saying they got kicked out once before because of an update, just make sure you have your updates done before you start your test. Sometimes Connect can be a little tricky, and usually there's always somebody that has an issue taking a test. So we may have that issue. We have a pretty good amount of students in this class. So just like I said, text me if you have a problem. Okay, any other questions?
Nope.
I think that's it. Okay, guys, have a good week. Well, it's the end of the week now. Have a good weekend. And
Thank you too.
good luck on the test. And I will see you the following week, which is September 8th, I believe. Yep.
Thank
September
you.
8th. Okay, good night.
Thank you. Good night.
Hello,